Accounting ratio definitions and types. Now, if you want to know what this is, stick around. If not, do not tap the dislike button. Just move along. Have you ever looked at a company's now? This is what it. If you want to, give me under 5 minutes. Have you ever looked at a company's financial statements and wondered how experts can tell within minutes whether the business is healthy or struggling? They don't just stare at raw numbers. They use something called accounting ratios. Accounting ratios are financial calculations used to analyze and compare different parts of a company's financial performance. In simple terms, they turn large amounts of accounting data into easy to read indicators. Think of them as financial health signals. Instead of reading pages of reports, ratios help answer key questions like: is the company profitable, or rather, is the business profitable, or can it pay its debts, or is it using the money efficiently, or is there someone sharpening of their funds somehow? That will take more detailed, in-depth analysis, but it's you can skim your mind through it. That's why they are so widely used by investors, managers, lenders, and accountants. Now, there are several types of accounting ratios, but let's focus on main ones. The first type is profitability ratios. These measures how well the businesses generate profit from its sales or assets. Ratios like gross profit margin and net profit margin fall into this category. Second type is liquidity ratios. These measures whether the company can pay its short-term obligations. A common example is the current ratio, which compares current assets to current liabilities. The third type is efficiency ratios. These look at how effectively the company uses resources like inventory turnover, receivable turnover. And the fourth measure type is solvency ratios. These measure long-term financial stability and debt levels such as debt to equity ratio. Let's make this simple. Imagine a company that makes 100,000 in sales and 20,000 in net profit. That means its net margin is 20%. Straight away, the ratio gives us faster insight than just staring at raw numbers. This is exactly why accounting ratios matter. They simplify interpretation. Now, why are they so successful? Why are they so useful, I should say? Because numbers alone don't always mean much until you compare them. 50,000 in debt sounds high, but compared to what? 10,000 in profit sounds good, but compared to sales of how much? Ratios create context. They also allow comparison between years or between different companies, making decisions much far easier. A common misunderstanding is thinking one ratio tells the whole story. It doesn't. Ratios are indicators, not complete answers. They need to be viewed together. Another misconception is that the ratios are only for accountants. In reality, investors, business owners, and rely heavily on them because they quickly reveal the strengths and weaknesses. So, what's the key takeaway? I will tell you because you've waited this long. Accounting ratios are financial tools that convert raw accounting numbers into meaningful performance indicators. They help measure profitability, liquidity, efficiency, and solvency, making business health much easier to understand. Once you understand accounting ratios, financial statements stop looking like random numbers and start telling a very clear story. What did you think of that? Less than 4 minutes. Bye bye.